Hi, everybody. It's Peter Schiff. It is Friday, May 3rd, 2013. We had a big rally in the stock market today. Intraday, the Dow Jones actually traded above 15,000 for the first time ever. We didn't close at that level, but we're still up about 140 points. The catalyst for today was the better than expected jobs report that came out before the market opened. In fact, before that report came out, gold was trading up by about 10 to 15 bucks. And the minute the number was released, gold sold off. It went negative by about the same amount. It settled out the day about unchanged. But the reaction indicated that traders are looking at this better than expected economic data as evidence that there's no reason to buy gold because the economy is getting better. We're creating jobs. The unemployment rate came down. Maybe the Fed won't do as much QE as we thought. But the fact of the matter is, all of the jobs that were created, the reason they were created was because of QE. QE is the only reason we're creating these jobs. And if the Fed ever were to taper it back, the jobs would disappear. As a matter of fact, the Fed is going to have to up the size of the QE to sustain these jobs. Just like, with any drug, you develop a tolerance. And so the more you use, the more you have to use. And so we're going to need ever increasing doses of QE to maintain these phony jobs. Meanwhile, the data itself was not even good. I mean, sure, it beat expectations because the bar had been lowered so much, but we only created 165,000 jobs. All of those jobs were in the service sector. We didn't create one manufacturing job, zero. So we're not creating the jobs that make us richer. We're creating the jobs that are actually going to drain our wealth because we're borrowing money to create them. The service sector jobs, they're in hotels, restaurants, bars, they're in retail stores. Some of them are in healthcare or business services, but a lot of these are part-time jobs. In fact, if you look at the hours worked, it actually went down from 34.6 hours to 34.4 hours. So a lot of these are part-time jobs. What I think is going on in a lot of these service sector jobs is, let's say you own a restaurant and Obamacare is coming. You can't, afford the health care. So you have to lower your hours for your full-time workers. So let's say I had a guy that was working 40 hours and now I brought him down to 20 hours, 25 hours to get below 30. Well, now what do I have to do? I got to go hire another part-time worker to fill the gap. Voila, I just created a job. A lot of these are part-time jobs. In fact, if you look at the U6 number, which is the unemployment number that counts part-time workers who actually want full-time jobs as being unemployed, that number ticked up to 13.9% from 13.8%. So that's what's going on. And these are low-paying jobs. They're not producing things that we can export. So it's not sustainable. A lot of it is simply coming from the wealth effect associated with housing. Housing prices are up. People can refi. They can take out home equity loans, and they can take that money and spend it. And when they spend it, there's jobs in restaurants, there's jobs in hotels, there's jobs at bars. But these are not jobs that are going to make the economy stronger, and they're not sustainable. Because what happens when the debt has to be repaid? Now, of course, what the Fed plans on doing is continuously providing more cheap money so that we can continue to create these phony jobs in a phony economy. I was watching on CNBC this morning, and Jim Cramer was actually talking about the fact that he believed that all these jobs were coming from the housing sector, higher home prices, more debt related to housing. But instead of condemning it for that reason, he was applauding it. What Cramer was saying is we need more housing. He said this proves that we're a housing economy, that it's all about housing, that we don't even need manufacturing. Instead of being upset that we're not creating manufacturing jobs, he wants to write off manufacturing. He says we need to build even more houses. He compared the number of houses we're building now to the number of houses we were building at the top of the bubble. And what he says is we need to build more houses. Build more houses? We're broke. We can't even afford the houses that we already have built. In fact, the home ownership level just hit a new 18-year low. The houses are being bought by speculators. It's hedge funds. It's private equity guys. What, Kramer wants us to build more houses so the hedge funds can speculate on them? I mean, this is a bubble economy, not necessarily a housing economy. It's a bubble. It is unsustainable. In fact, I was listening to an interview also this morning with Charles Munger, who is the #2 guy over at Warren Buffett's Berkshire Hathaway. And he was basically praising what Ben Bernanke was doing, yet he did acknowledge that Alan Greenspan was too loose, and that his loose money policies contributed to the housing bubble, which of course is an understatement. But then I think it was Becky Quick who was talking to her, asked Munger, well, but what's the difference between what Ben Bernanke is doing and what Alan Greenspan did? And the only answer he had said was that, well, Ben Bernanke is inflating, or she said to him, that the Fed is now using cheap money to boost asset prices and real estate prices. How is that different from what Alan Greenspan did? And his response was, well, Ben Bernanke is doing this after a crisis, and Greenspan just did it to make the bubble bigger. Well, how is that different? So it's okay to use cheap money to inflate a bubble, but it's not okay, rather, to use cheap money to inflate a bubble, but it is okay to use it after that bubble bursts to blow the air back into it. It doesn't make any sense. If it was wrong to do it before, it's wrong to do it now. I mean, how can you say, oh, we had a crisis because we had too much cheap money and we overinflated assets. The result was too much borrowing and too much spending. And now that we had a crisis, the solution is to do the exact same thing that caused the crisis, only now it's okay because we've already had the crisis. Well, what about the fact that we're setting ourselves up now for an even bigger crisis the next time around? Because instead of allowing the economy to repair itself, right, from all the damage that was done, we're just doing the same policies that screwed it up in the first place, saying that that's how we have to fix it. That's not how you fix a broken economy. That's how you break it more. Now, the better than expected jobs numbers are going to mask a lot of other economic data that came out during the week, including today, from the ISM and on factory orders that were all negative. In fact, all the data points were negative. And I think, again, if you look beneath the surface at the jobs numbers, it was a negative report as well. But the government keeps telling us that things are getting better. We also got this week consumer income and spending for March. And the government claims that spending is up by 0.2%, but that there's no inflation. So spending is up, but there's no inflation. But we also got the March trade deficit, which dropped by 11%. That's a huge drop. It's still a big deficit. It's like $38 billion and change. But our trade deficit with China dropped to a 3-year low. Now, if we're spending more money and prices aren't rising, how can our imports from China be collapsing? After all, what are we spending money on? What are we buying if we're not buying Chinese products? See, here's what I think is going on. I think we're spending more money on services, not because we're consuming more services, but because the price of those services is rising and the government doesn't admit it. See, people are spending more on rent. They're spending more on utilities. They're spending more on health care. They're spending more on insurance. They're also spending more on food. And because they're spending more money on all these other things, they can't afford to buy as many Chinese imports. So we're forced to spend more money on the things we need, and therefore we don't have the extra money to buy the things that we want. That's really what's going on. The standard of living is falling, and the numbers prove that. It doesn't. The government's trying to mask it behind these phony CPI numbers. In fact, in the Fed minutes, which also were released this week, one of the things the Federal Reserve talked about was that inflation was too low, that it was only about 1%, and so it's below their 2% target. And why is 2% a target? 2% used to be the ceiling. Whenever central banks had an inflation target of 2%, it wasn't that the goal was to get it up to 2%. The 2% meant was that if it ever got that high, we needed aggressive action to bring it down, because that was as high as we can tolerate. Now, all of a sudden, 2% is the floor. We must have inflation of at least 2%. Otherwise, we got to do something to create more inflation, which of course is what the Fed is going to do. You know, the Fed minutes that were released this week confirmed what I was saying all along. If you remember, the last time we had the Fed minutes, there was a line in there about that the Fed was ready to adjust its policy based on changing economic conditions. And at the time, everybody was talking about, you see, the Fed is getting ready to tighten. They're getting ready to end QE early because economic conditions are going to improve. And at the time, I said, the Fed's not saying that. The Fed said adjust. They didn't say which direction. It could be an upward adjustment. In fact, I said back then that they weren't going to slow the QE or end it early, that the most likely thing for the Fed was to increase the size of the QE. You see, I've been saying this all along. When they did QE1, of course, they didn't call it QE1 originally, but they announced QE, and I was on record as saying they're going to have another one. As soon as it's over, they're going to do it again. And then when they did have QE2, right, I said, okay, we're going to have QE3. And then I was saying there'd be more QEs than Rocky movies. I knew that QE would never end. All the other so-called experts were confident that each QE was the last one. Now, the reason I knew that it wouldn't be the last one is because I knew it wouldn't work. In fact, not only wouldn't it work, but I knew that QE would make the very problem the Fed was trying to solve worse. See, I knew they were throwing gasoline on a fire. Everybody else thought they were throwing water on the fire, so they expected it to go out. But I knew it would get bigger. Well, what did the Fed say in these minutes? The Fed basically clarified that statement. It actually inserted the phrase that the Fed is ready to increase or decrease QE based on circumstances. So now the Fed came out and said, hey, wait a minute, we might do even more QE. And of course, that's exactly what they're going to do. There's no chance that they're going to end it. They are going to have to increase the size because that's the only way to keep this phony expansion going. But of course, the Fed's not going to say that. The Fed can't come out and tell the truth because it knows the public can't handle the truth, so it feeds us lies instead. But of course, we're going to get more QE because the problems get worse every time we get QE, and then we need a bigger dose because we're more addicted to the stuff. And sure, the stock market can go up in that environment. You know, I was on CNBC today myself, and I was debating somebody about the market. And of course, I don't think it's going down. I think it's going up, but I think it's going up for all the wrong reasons. The thing is, my opponents seem to agree with me, but he sees no problem with that. He said, hey, we have all this cheap money, and so you buy stocks. Well, that's my point. But his point was basically, well, they're playing the music, so let's dance to it. But my point is, wait a minute. We shouldn't be dancing. We should be worried about what happens when the music stops instead of just partying like it's never going to stop. Because that's the exact same attitude that we had before the 2008 financial crisis. We've got the same attitude now. The next crisis is going to be worse. Not because maybe the stock market drops as much. I mean, the stock market would drop if the Fed did the right thing, but it ain't going to do the right thing. It's going to keep doing the wrong thing. So eventually it's the dollar that's going to drop, and it's going to drop hard. And when that happens, the impact on the U.S. economy and our standard of living is going to be much more dramatic than what happened in 2008 when the dollar went up and bonds went up. See, I think the order of the collapse is dollar first, bonds second, then stocks, and only if the Fed eventually does the right thing. If the Fed never does the right thing, then the stock market's going to keep going up. But who cares? Because the price of food is going to go up even faster. The price of gasoline is going to go up faster. The price of everything is going to go up faster. And so what if the stock market has gone up if you're poorer? The bottom line is the media is going to cover this. The unemployment rate has gone down to 7.5%. That's like a 4-year low. We're creating jobs. They're going to say that things are getting better. They're not. They're not getting better. They're getting worse. The government statistics don't tell the whole story. In many cases, they tell the wrong story. And eventually, of course, when the music does stop, these jobs are going to disappear, along with the phony economic growth that went along with it. One way or another, it's going to happen. Whether it happens because the Fed does the right thing on its own, or more likely they're forced to do the right thing by the market because of a currency collapse and a bond market collapse, we'll have to see. But the one thing we know for sure is this growth is not real, and neither is the new high in the stock market. It is an illusion. It's being manufactured by central banks, and it's not just the Federal Reserve. You know, we got news from Europe this week. The Europeans cut their rates. The ECB dropped interest rates from 75 basis points to 50 basis points, as if that's going to work. Again, the definition of insanity, doing the same thing over and over again and expecting a different result. Where were interest rates when the ECB started cutting? And they were a lot higher. I don't remember if they were 4% or 5%, but wherever they are, they've already reduced them dramatically. If cutting interest rates worked, it already would have. The fact that it hasn't worked doesn't mean an extra 25 basis points is going to produce any different result than all the other basis points that have been cut prior to that. Think about it. I mean, the whole idea behind the rate cut is to stimulate the economy because people will be more likely to borrow and spend when interest rates are low. Well, if you're a business, do you think there's any businessman in Europe that wanted to borrow money but isn't because rates were too high at 75 basis points? And now rates are reduced to 50 basis points, and now this business says, oh, wait a minute, 50 basis points, yeah, I'm in. Sign me up. Let me take out a big loan. I mean, 75 basis points was way too much, but now that you cut it down to 50 basis points, yeah, I'm going to borrow money. Is anybody going to do that? Or what about the guy who was putting his money in the bank? You think he's going to say, now that the interest rates are down from 75 basis points to 50 basis points, I'm not going to save anymore. I'm going to go out and buy stuff. I mean, when I was getting 75 basis points, yeah, I mean, I'm going to save. But hey, I'm no fool. You cut me down to 50 basis points. Hey, no deal. I'm spending. This little teeny difference is not going to affect behavior very much. All it's going to do is make it cheaper for the people who are borrowing anyway to borrow. The people who already have debt. It'll make it a little bit cheaper to service that debt. Meanwhile, the debt's going to get bigger. And so eventually the fact that it's a little bit cheaper isn't going to matter because now there's more of it. And now the Fed has to, or the central bank, any of the central banks, now they got to cut rates again so that this huge debt is serviceable. But none of this helps the economy. What does it do? It transfers income from the savers and the lenders to the borrowers and the spenders. How is this good economics? It's not. It's bad economics. And rather than promoting growth, it stifles growth. And it actually exacerbates the structural imbalances that are preventing growth, which is how I know they'll keep on doing it. So the Europeans are making the mistake. Look, the Japanese have been doing it for years and years. It hasn't worked in Japan. It's not working in Europe. It's not going to work in America. But is there any central banker anywhere that has figured this out? Have any of the investors figured it out? Maybe they don't care. Because they're all, in this bubble. They're all drunk on cheap money, and they see the stock market going up, and they don't care. They don't care why it's going up. All they know is that it is going up. All the music is playing, and they're having a great time at the party. The alcohol, the champagne is flowing. Everybody can party, and they forget that's the exact attitude they had back in 2007 before the bottom dropped out in 2008. Well, this is a bigger party. We got even more alcohol, and when it wears off, the hangover is going to be far worse again than it was in 2008. That's all for now. Thanks for listening. I'll be blogging again soon. Take care, everybody.